as employers have struggled to find labor. I do want to mention the Lululemon story just in the last few seconds that we have. Shares tumbling after the yoga wear maker cutting its margin forecast. Lululemon shares tumbling after the maker of fitness wear lowered its guidance for gross margins, stoking fears about profitability for a second straight quarter. Well, don't go anywhere, because coming up, we're joined by our friends at Bloomberg TV for our countdown to the close. Bloomberg's countdown to the close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left here in the trading session. Romaine Bostic, Scarlett Fu. We're joined right now by our colleagues, Tim Stenovic and Kriti Gupta. Carol Massar has the day off. We welcome our audiences across Bloomberg Television, Radio, Quick Take, as well as on YouTube. And Tim, we talked on Friday here about that relentless rally that we had. There was a lot of talk about how much conviction and follow-through there would be here on the Monday. We got a little bit of it, but now starting to fade.
It is. I wonder if their investors are actually starting to kind of pay attention to what the Fed said in its meeting minutes last week, or perhaps the two Fed members who are not voting, who we did hear from earlier today, that, you know, I don't know, I kind of feel like we see this time and time again, Kriti, over the last year, right? These rallies that are then, you know, kind of shut down by the Fed. We'll hear from Jerome Powell later this week and hear if he comments on it at all. Yeah,
we got to put it into some context, though, because a lot of people are saying this is the real first trading day of the new year. Everyone's back at their desk. You're seeing a lot of high volume, Romaine, about 30% higher on a 30-day average for the S&P 500. So, yes, they are pairing their gains, but they are still up. And whatever buying, it's conviction buying.
Yeah, of course, interesting moves that you're seeing in the Treasury space here on the day. And then you take a look at the broader equity market here in S&P. They had a relatively tepid open, then rallied pretty hard. It was up more than 1% here on the day. Now, right now, only up about 0.2%. The Dow Jones Industrial Average flipping into the red, down about 0.2%. The NASDAQ and the Russell trying to hold on to some of their gains on the day. We should point out, a lot of the cyclical names are really leading the charge here on the day. The Russell up about 0.4%, but the Dow Transport's up more than 1%.
And I'm going to pick up where you left off, because you really see last year's losers leading the way today. And to Kriti's point, if today is really the first real day of trading for the new year, tech and materials are the best performers here. Tech, of course, big losers last year, off by 29% as a group. Today, they're up by 1.8% and certainly boosting the NASDAQ 100. On the downside today, you've got healthcare and staples, your perennial defensive companies. The defensives, of course, did better than most other sectors in 2022.
When you talk about the individual movers, one of the ones out front today here is Exact Sciences, up about 26% here. The company going to be presenting at that JP Morgan conference that we're going to be covering heavily here at Bloomberg. They came out with their preliminary numbers, and they were good. Shares up 26% here on the day. And then, of course, there's a big focus right now on consumer spending, and it's a bit of a mixed bag here. You have a name like MasterCard up about 1% here on the day on the back of an upgrade, as well as some, I guess, optimism about its diversification in where some of those transactions go. But then you had Macy's come out on Friday and give preliminary numbers for the fourth quarter, saying that they were going to be at the low to midpoint of its prior range. Those shares down 7% here on this Monday afternoon, and then Lululemon down almost 10% here on the day after pre-announcing as well. A lot of concerns here about the potential for a margin contraction. 1.1 percentage points is what the company is guiding towards. And of course, that brings us to the start of the earnings season, which of course kicks off on Friday, at least officially here. And a lot of talk about profit margins. You take a look at the chart on this screen here, which shows you U.S. corporate profit margins. And this is BEA data, basically the government data. So a little bit backward looking, only going through the third quarter here. But I wanted to show you that peak, because we saw the highest relative value of profit margins going back all the way really to the 90s here. And that's a big part of the concern. It's not just that profit margins are high, but the idea that they're basically near their peak, at least their cycle peaks, and a lot of people think that that just can't be sustained, particularly not with some of the economic forecasts.
That's when inflation is good for earnings, because they boost revenue, until, of course, you start to see a slowdown in demand because the Fed has to respond to that rising inflation.
And of course, if you're paying your employees more and everything costs more to get, and that certainly eats into margins. We spoke to Gina Martin Adams a little earlier in our program, and she said the number one thing that she's watching when it comes to earnings season this year is margins forming some kind of bottom. Well, let's talk a little bit about areas of the market that could be appealing at some sense, or in some sense of the word. Lori Calvasina from RBC Capital Markets earlier today was on Bloomberg Surveillance. She's head of U.S. equity strategy there. She was asked by Lisa Abramowitz how much more damage needs to happen to tech stocks for them to become appealing to her. Check out what she had to say.
We really want to buy tech as a recovery story, so we need to put that market bottom in before we can really get to a point where you want to buy the tech sector. You might not necessarily get super cheap valuations before investors will move back in, but you do probably need to get better valuations, or at least more certainty around valuations than what you've got right now before you'll really see sustainable buyers come back.
That was Lori Calvasina from RBC Capital Markets on Bloomberg Surveillance a little earlier today. Crito, I wonder if we're starting to actually see investors move back in, but I mean, it's hard to judge based on one day, especially when we saw it such a laggard in 2022.
Well, that's going to be the real question for the front half of 2023, because the consensus here is that you are still going to see another dip. The market has not bottomed out for the front half, but that the real recovery, the sustainable bull market, is going to come in the back half of the year. But in these early signs last week, and I would argue today as well, you're not quite seeing that yet. So, Romaine, I wonder what that pivot point is going to be, where you start to see even more pain in the equity market.
Well, you talk about the pivot point, I guess, and it goes back to your point, Tim, here. The question is what are you valuing things at here? Some people would look at tech stocks and certainly would look at the aggregate market and say, even on a historical basis, valuations are too high. And if you believe earnings are going to come in lower than what the market is priced in, then that valuation should be lower. If you think a recession is coming, then that valuation should be lower. This is going to be the push-pull that we're going to get, I think, if not for weeks, maybe potentially months.
Yeah, there's a Bloomberg survey, the weekly MLive Pulse survey, that found half of respondents in a Bloomberg survey of professional and retail investors see the S&P 500 PE ratio going down through this earnings season. And as a result, they're really looking to continue to bet on value stocks as opposed to taking flyer on growth stocks. They're not ready for that yet, despite what we're seeing today.
Have you heard that before in the past? I mean, it wasn't every year for the last 15 years, value was set to outperform.
Well, I mean, technically it did. I mean, it had its year. I mean, whether that sustains itself. But again, you go back to the value. What are you paying for? I mean, are you getting the premium that you want? I don't know. I mean, look at the differential. I mean, you take the earnings yield and you go put that up against the 10-year yield. I mean, that premium is probably the smallest we've seen in a decade.
You're getting peace of mind.
Peace of mind?
People want some sense of certainty. They're going to get a dividend as opposed to...
There's no such thing.
No, there isn't. But for people who are looking for something, that is something substantive.
Always worry.
Well, I would argue
that's what I subscribe to also.
I would argue it's a cross-Atlantic trade, though, because sure, you've seen value outperform, but I wonder if value is going to outperform again. You're going to start to see that in, say, the European names, Europeans outperforming, or European stocks outperforming American stocks, for example.
And they already are. And of course, we've been talking all day about emerging market stocks, and of course, what we've been seeing in Asia, the outperformance there. Maybe that ends up becoming the trade.
Yeah, speaking of Asia, we're talking China next in just a couple of minutes here on Bloomberg Radio.
Something going on?
That reopening. That's the big question. The U.S.
People are moving around.
What's that?
Traveling. People are moving around.
I know. The big question is what is the global economic impact of that, and of course the U.S. economic impact as well.
You should add, I don't know who you're talking about. You should
Anna
ask
Wong
a lot about some of the softening and stances. There was a lot of talk about the Jack Ma announcement.
Yeah.
And this maybe signals sort of an end or a winding down of all that sort of regulatory crackdown. I don't know.
Okay, we'll ask her. She's joining us in
I have some other
just a
questions.
few minutes. All right, well, tune in. You can call in, Romaine. We'll let you.
Can I?
Yeah,
It's
long
a
time
show.
listener, first time caller, Romaine.
Okay.
All right.
Romaine from Massapequa.
That is going to do it for our cross-platform coverage, at least for now. We'll be back again live on TV, radio, and YouTube, and Bloomberg Quick Take, now from 2 to 5 p.m., streaming on Quick Take. Then, of course, at 4 p.m. for our Beyond the Bell coverage when we take you through today's market close. Bloomberg Business Week is what's going on in China. As of Sunday, the country no longer requires quarantine for arrivals. This after authorities ditched the policy that, along with the exorbitant cost of airfares amid severe capacity constraints was a major deterrent for travelers. While anyone wanting to enter the country will still need a 48-hour negative COVID test result, the substantial easing in border controls just 2 weeks before the Lunar New Year holiday marks an end to Beijing's efforts to keep out the virus. It's just the final stop in the dismantling of COVID-0. What's the global economic impact? Well, Goldman Sachs Group said Chinese stocks may rally another 15% after a great start to the year. With more, we're joined right now by Anna Wong. She's chief U.S. economist at Bloomberg Economics. She joins us via Zoom from Washington, D.C. right now. Anna, it's always good to chat with you. Thanks for taking the time. I got to tell you, I am pretty surprised about the quick pivot that the government of China, the Chinese Communist Party, has made when it comes to COVID-0. We're certainly seeing it play out when it comes to equity markets, when it comes to commodities markets. What are you watching at Bloomberg Economics about the U.S. impact when it comes to the economy here of the second largest economy in the world opening back up?
Right. For the U.S. economy, the key things that investors are looking for this year is how fast will inflation come down and whether there will be a recession and how deep that would be. And the way that China is related to these two important questions is that I do think that China is one of the few wild cards that could help the U.S. avert a recession. So or it could also be the wild card that could cause the U.S. to get a deeper hard landing. So how does it work? So China is a big commodity buyer, importer in the world. And, if you look across a range of commodities, China accounts for 40 to 50% of total world consumption. So when China's demand slump, commodity prices slump, and that's what we are seeing right now because of this deeper disorderliness in China's exit from COVID-0. Commodity prices, oil prices, has been slumping, and that has helped boost the U.S. chances of a soft landing because our gasoline prices are suddenly coming way down, and so. I used to work at the Fed, and I had a paper with my colleagues there on the global spillover impact of a China hard landing. And we estimate that, for example, if a China hard landing subtract 2 percentage points from China's GDP growth, it could cause commodity prices to be lower by up to 20%. So the China team in Bloomberg Economics are currently seeing the China reopening to be faster and more rapid, and our team expect that China's reopening will be completed by mid 2020. And in this period, toward that full reopening, if things get really messy, we could suddenly see commodity prices coming way down, and there's still more room to fall. But once China's complete with the reopening, we could then see commodity prices rise by up to 15 to 20%, because our team does see that full reopening will boost Chinese growth by 1.6 percentage point in the 12 months after the full reopening.
So then what is the case here that this Chinese reopening is in fact deflationary at the end of the day? That was one of the big fears that was talked about when it comes to, well, is it correctly being priced in if you start to see a massive spread of COVID? Is that still a fair argument to talk about?
Yes, it is still fair. And I think the confusion here is that it's not just a single straight line deflationary trend or inflationary. I think the process to get to full reopening would be very deflationary. And depending on how disorderly it could be, like, for example, in the last week of January, China will have Lunar New Year. That's when everybody traveled within China, and cases could explode then because people are traveling. So it depends on how bad the public health casualty could become and what will happen as a result of that massive casualty. And during that period, it will be very deflationary, but ultimately China will exit COVID-0, and that period where growth would rebound would be inflationary. So it's like, a V-shaped recovery in China will probably lead to a V-shaped contour in U.S. inflation.
So talk about the connection, though, between, we understand the commodity connection. And I think over the last couple of years, the people who've only watched the market from afar now understand the supply chain connections. But as companies have learned to deal with COVID-0, look at Apple and Disney, Nike, for example, then how do you connect it to the U.S. economy and the companies that do business in China?
Well, first of all, U.S. is experiencing this consumer consumption pattern shift away from goods towards services, and the goods are a lot of that is imported from China. So even assuming that U.S. growth stays constant, the stuff we desire from China was going to plunge anyway, because we don't want any more furnitures or toys and those apparels, that stuff that are produced in China, and so that aspect alone will lead to less sensitivity of the inflationary aspect of the supply chain problems from China.
Well, what does that mean then when it comes to sectors like, you know what? I'm going to change my question mid question.
You're allowed to do that.
I am allowed to do that, but it didn't come off as clean on air as I was hoping, because I just feel like Anna can answer so many questions. So I want to ask her everything. And I want to ask you more about the Chinese consumer. I think that's a bigger and more important issue when it comes to how it relates to the global economy. We talk a lot about these supply chain issues coming out of China and then affecting the American consumer. But what about the Chinese consumer? That's still over 1 billion people.
Oh yeah, so the last 2 years with that suffocating COVID zero policy, consumption in China really tanked. And the interesting thing is, 3 or 4 years ago, the big story for any China watcher is that China's domestic consumption, is going to power Chinese growth. That didn't happen because consumers buy or spend depending on two things. One is housing. So if they buy houses, which a lot of Chinese people were buying domestic housing a couple of years ago, they would buy more stuff to fill the houses. So housing was slumping in China. Number two, with uncertainty and rising unemployment and just the uncertainty of future because of COVID zero, people becomes more pessimistic about the future and therefore buy less. And that's why we saw very, very bad retail number coming from China, way worse than anybody could imagine. And now with China reopening, that V-shaped recovery in China would be quite powerful on the way up, just because you have 2 years of bottled up, pent up consumer demand.
Hey, Anna, I want to broaden out our conversation just in the last 2 minutes that we have with you, because I was reading through, as I do each and every week, the U.S. Week Ahead that's available to Bloomberg Terminal subscribers. You oftentimes byline that along with Eliza Winger, another economist at Bloomberg Economics. Something really stuck out to me from this. You write about signs that you are starting to see that give you the expectation that the Fed is going to further downshift the pace of rate hikes to 25 basis points at its next two meetings, one of those meetings coming up at the end of the month, the beginning of next month, and then hold rates at 5% for the rest of the year. Wait, what? 2 more 25 basis points rate hikes and that's it?
Yeah. I mean, and that would be in line with what the market is currently pricing in the futures market. I do think that the Fed is underappreciating the powerful near-term deflationary pressure, partly stemming from China, as we have discussed. And I think that the Fed is underappreciating how messy this China exit from COVID zero is. They're still thinking about the supply chain impact, the inflationary impact from supply chain. But the thing is, China's as I mentioned, U.S. consumers have shifted away from Chinese produced goods, and therefore I do think that it's on net more deflationary than the Fed thought, and that's why I think that the terminal rate could end at could peak at 5%. The second factor is I do think that the CPI report that we're going to get this week and for the January, both of them are going to show headline CPI being deflation.
Right.
So we're expecting negative 0.2% in the December report we get this week, and we're expecting negative 0.1% for the January report. At least it's tracking that way.
Okay, we'll call you back on Thursday to check in on those numbers. Anna Wong, Chief U.S. Economist for Bloomberg Economics. It's always great when you join us. Really appreciate you taking the time. Anna is, of course, Chief U.S. Economist for Bloomberg Economics, joining us from Washington, D.C.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash is brought to you by Innovation Refunds. See if your small or medium-sized business could be missing out on an opportunity. Was your business impacted by COVID-19 in either 2020 or 2021? Well, it may qualify for the Employee Retention Credit. The professionals at Innovation Refunds can help your business recover from the pandemic. See how much could be waiting for your business at getrefunds.com. Let's get you the latest on the price action as we cross to the Bloomberg Macro Squawk Desk and check in with Bill Maloney. Hey, Bill.
And good afternoon, Doug. U.S. stocks trading well off their session highs, with the Dow now down 72 points, was up 304. S&Ps are still up 8, and NASDAQ is still up 107. The U.S. 10-year yield at 3.51%. Gold is higher by 5. Oil trading in the green, and Bitcoin is higher by 1.7%. Among the main 11 S&P sectors, leaders were tech, materials, and utilities. Healthcare was under pressure, and leaders to the upside in the Dow, Salesforce and Intel, while Merck and J&J led to the downside. Lululemon fell 9% after cutting its gross margin forecast. And in other news, Fed's Daily says 25 and 50 basis points are both on the table at the next Fed meeting. Also, Disney is telling workers to come back to the office 4 times a week. Wrapping things up, Jefferies reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug.
All right, Bill, thank you. And if you have a Bloomberg terminal and you want to get live audio updates on it, the function is SQUA Go. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thank you so much for that update, Doug. Really appreciate it. Well, Brazil's capital of Brasilia recovering today from an insurrection by thousands of supporters of ex-president Jair Bolsonaro, who stormed the country, top government institutions, leaving a trail of destruction and testing the leadership of Luiz Inácio Lula da Silva just a week after he took office. Rioters ransacked Congress, the presidential palace, and the top court in Brasilia on Sunday, hoping to trigger a military intervention. It took hours for security forces to regain control of the main government buildings. Hundreds were arrested. Throughout the night, thousands, though, of Bolsonaro supporters remained in the area. For more, we turn now to Julia Leite, Brazil country chief for Bloomberg News. She joins us on the phone from Sao Paulo, Brazil. Julia, good to have you with us this afternoon. Just want to get from you the latest on what we understand about these insurrectionists yesterday.
Hi, thanks for having me. So Brasilia is in really recovery mode. Police are gathering evidence and really booking thousands of protesters who came back to a military, like they have been camping in front of a military facility about 8 kilometers from where the protest took place. And they walked back there. Thousands of them walked back there after the protest. And today they were removed and taken to police for questioning and booking. And really, it's a swath of evidence that police and the ministries now have to go through. Lula, meanwhile, is reasserting his power. He met with the chiefs of Congress, the chiefs of the Supreme Court today, really putting up a united front against these protests and looters, really.
And Julia, this is coming, of course, as Bolsonaro is, I believe, hospitalized as well. Can you give us a little bit more context on that?
Here in the U.S., right?
Yeah, here in the States.
Yeah, that is right. Bolsonaro flew to Florida at the end of December, right before Lula was inaugurated, which was last Sunday. And he has been really just taking pictures with supporters. There's been videos of him in supermarkets, at KFC. So really just on vacation in Florida. And today we heard that he has been hospitalized, which has been confirmed by his wife. And really, Bolsonaro has been hospitalized many times since he was stabbed in 2018 on the campaign trail. It's usually abdominal problems that he has, so we're monitoring that situation.
And what does that mean in terms of his response? Has he responded to the protests that he's seen, or has he been kind of out of commission here?
He has, although he has been mostly silent since losing the election on October 30th, both skipping public events and on social media, which is where he always had a huge presence, both him and his family. He did tweet last night saying these kinds of riots, these sort of demonstrations are not within the rules of a democracy, and very quickly trying to distance himself from protests because there were immediately allegations that he was, he helped stoke protesters and was behind these actions. So he was very quick to deny that. So we shall see what happens next with that. The Justice Minister said that at the moment, he cannot be legally responsible for what happened yesterday, but he did say politically, Bolsonaro is unequivocally responsible for some of what happened yesterday.
I think a lot of people, when they first saw images of this, they thought of January 6th here in the United States, and some similarities between the two. Julia, a different part of the conversation, though, has to do with the demands of these insurrectionists. What was the commonality that tied them together, sort of, apart from the idea that Bolsonaro was the one who won the election?
Yeah, I think that's the main thread. They wanted to, they refused to accept the result of the election, and they were asking for the military to intervene and keep, and take Lula out of office. And that was, and you're right, the images were very similar to what we saw in the Capitol 2 years ago, almost to the date. One difference that we saw was police initially did not really resist the protesters, unlike in the U.S. So they ran rampant for about 2 hours before reinforcements arrived and really started taking people out of the buildings. But by then, the damage to works of art and really to the building structure was just countless.
Another difference that I noticed was the fact that so many protesters, insurrectionists, were actually arrested immediately. This is not something that happened here in the U.S. What do we know about the people who have been arrested and the consequences that they could face if they are indeed found guilty?
Yeah, that's right. A lot of people were arrested kind of on the act. I think a couple hundred. The numbers vary depending on the government agency that is commenting on it. But it was all over social media. People were posting selfies and videos while they were looting the buildings. So it is a trove of evidence that police now has to go through and just keep, finding these people and arresting them. Although a lot of videos have been erased, even social media accounts have been wiped. But the Supreme Court last night ordered that the evidence be preserved and really started going after these people, and not just the people who were there, but the people who financed the act. That's been a very key point from all authorities commenting about the aftermath of this, is that they really want to go after the people who bussed thousands of Bolsonaro supporters over the past few days to Brasilia for these protests.
So, Julia, talk to us a little bit about the market reaction here. Damian Sassower, our Bloomberg Intelligence Chief Emerging Market Strategist, kind of said that, look, these are emerging markets. A lot of this geopolitical risk is actually priced in. Bloomberg Economics, on the other hand, saying, look, there could still be a lot of pain. It could shave off 0.7% when it comes to economic activity in the month of January. Is that something the markets are responding to?
So when markets opened, it was really looking like a horrible day, especially considering it was such a risk-on day abroad. So both stocks and the currency were underperforming massively. As the day wore on, things did improve. Both the mood here improved and the risk-on sentiment that we were seeing abroad kind of faded a little bit. So in the end, it wasn't as bad as it could have been. But, Brazilian assets have been underperforming since Lula won the election, really, because investors have begun to worry that his comments on how much he's going to spend and comments from cabinet members that he just appointed about revoking, the labor reform and the pension reform, both of which investors really see as key in keeping government accounts in check, are really weighing on assets. So it's a bit longer than just today.
Julia, what are you watching for now? What's the smart question that our investing audience needs to be asking as Brasilia continues to recover from this?
I think there are a few things. One is, will this happen again, right? Authorities say this will never happen again, but there are still thousands of people in Brasilia So we really need to be on the watch for a resurgence of violence. And then whatever comes out of these Supreme Court requests and inquiries, there are several arrest warrants that have already been issued. We don't have names yet, but it really could shake things up in politics and in the system depending on what they find in terms of who financed and who stoked protesters. So I think those are the main things that we're watching for.
All right, Julia Leite, Brazil country chief for Bloomberg News, joining us this afternoon on the phone from Sao Paulo, Brazil. Just to update our audience, if you're just now joining us, we were speaking to Julia about Brasilia, the capital of Brazil, reeling after anti-Lula rioters stormed Congress over the weekend. A big thank you to Julia for taking the time and joining us to bring us the latest from there. We're seeing a little bit of pullback in equity markets this afternoon. The S&P 500 actually just turning negative, now down 0.03%. The Dow Jones Industrial Average down 0.4%, so today's rally losing a little bit of steam. The Nasdaq has given up quite a bit of its gains, though it still is higher by 0.7%. In just a few minutes, we're going to be joined for our drive to the close and do a deep dive on today's trade and what to expect moving forward. In the meantime, though, let's get a check on the latest world and national news. For that, we go to Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The next test of Kevin McCarthy's power in the House will be coming tonight. When lawmakers vote on a new rules package, Bloomberg's Eric Wasson says there is some dissension among the ranks.
Literally, the House cannot do any investigations, any legislation until it adopts the rules. Unlike the Senate, it has to, every time a new Congress comes in, start with those rules. And there is some trouble there. Tony Gonzalez, a moderate Texas Republican, has said he's going to vote against it. Nancy Mace, moderate from South Carolina, also may vote against it. And they really can only afford to lose 4.
Bloomberg's Eric Wasson says some of those moderates worry that McCarthy gave away too much to the Freedom Caucus in order to become Speaker. President Biden is in Mexico City for talks with the leaders of Mexico and Canada.
Both the United States and Canada have been pressing Mexico's president to accept investment by foreign oil companies to increase production, former U.S. Ambassador to Mexico Tony Garza said in a Bloomberg interview.
López Obrador has a very nationalist view of the role of the state in the production of oil and gas. My guess is at the end of the bilateral, they will simply announce a continued commitment to discussions, consultations, and a desire to resolve.
López Obrador, Garza said, is violating the trade agreement with the United States and Canada, which have the right to bring the issue to arbitration. In Washington, Irv Chapman, Bloomberg Radio.
The special grand jury in Georgia has finished its probe into former President Trump's attempt to reverse his 2020 election loss in that state. The grand jury completed its final report. It will now be up to Fulton County District Attorney Fannie Willis to decide whether to file criminal charges. And doctors say Bills safety Damar Hamlin is out of the hospital and back in Buffalo, a week after going into cardiac arrest during a game with the Bengals. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
We're about 19 minutes away now from the closing bell. The equity market has turned mixed. That occurred when the head of the Atlanta Fed Bank, Raphael Bostic, said the Fed should hike its key rate, that would be the Fed funds rate, above 5% by early in the second quarter and then go on hold for a long period. Now, needless to say, these remarks have helped to take the equity market from session highs. The Dow right now is down about 0.4%. The S&P off 0.1%. NASDAQ comp is up just 0.7%. And we have yields lower across the curve, although not at levels that we had seen earlier. 10-year Treasury now at 3.53 with a loss of about 2 basis points. A 2-year at 4.20, down about 4 basis points in yield. Shares in Macy's being very hard hit today. The stock is down more than 7% after the retailer said holiday sales were weaker than forecast, and Macy's sees continued pressure on the American consumer in 2023. Also being hard hit, Lululemon Athletica, the company lowering guidance for gross margin. This has stoked a lot of fear about profitability for a second straight quarter. Lululemon right now down just about 9.8%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Bloomberg Business Week is brought to you by Innovation Refunds. Are you looking for ways to grow your business? Get back the money that you may be eligible to receive through the Employee Retention Credit. Sign up now before it's too late. See if your business qualifies for ERC assistance at getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is the Drive to the Close. Tim Stenevec and Kriti Gupta in for Carol Master this afternoon. We're just about 17 minutes away from the close of equity trading here on this January 9th, 2023. And we're seeing markets roll over quite a bit. The S&P 500 was as high as higher by as much as 1.42% earlier. Now it's just up just fractionally, less than 0.1%. Really eager to hear what our next guest has to think of, not just today's trade, but of the outlook for the year. We've got Gina Bolvin with us, president of Bolvin Wealth Management Group. She joins us this afternoon on the phone from Boston. Gina, how are you?
Hi, how are you? Thank you for having me, and Happy New Year.
Happy New Year to you, too. Thanks so much for joining us. Well, let's talk a little bit about the trade moving forward, because if the theme of last week and the year has been, and it continues, how high will inflation go? Has it indeed peaked? And how high will the federal funds rate have to go in order to tamp down inflation? What's top of mind for you at Bolvin Wealth Management Group?
Oh, well, yes, last week was such a good week for the market. What kicked it off is a jobs report, and there was something for everyone there. And it was surprising to the upside. And we still have that broken record of bad news is good news is bad news. A slower wage growth, which helps bring inflation down, was good for investors because it gave investors hope finally that the Fed may not have to raise rates as much and as long, and maybe they might even have to cut rates. And there's a glimmer of hope of a soft landing. So that's what happened last week, and we also saw the ISM survey was surprising, where the service industry contracted for the first time in 2.5 years. So we're starting to see that the interest rate hikes are making their way into the economy, and most of the work the Fed had to do to slow the economy may be behind us.
Well, Gina, one of the historical trends that has really kind of thrown me for a loop here is that after midterm elections, people tend to buy in. For the equity market, for a lot of the bulls waiting on the sidelines, I think they were waiting for some sort of gridlock in Washington to come to fruition before hopping back into the market. And we haven't really seen that with the same conviction we've seen it in the past years. Any idea why?
Well, I think that one of the reasons is because we've had 7 interest rate hikes, and we've had 40-year inflation highs. So, but I do think that we are going to see it. You know, when you look at history, that is one of the trends that we see is that after the midterms, no matter who wins, there's an average gain of about 14% in the market. So that is one of the reasons why we think the market this year will be up double digits, 12 to 15%, but it's just going to take all year to get there.
What's more important to you? Technicals like that, the sort of farmer's almanac statistics that you know look back on over the last 100 years or so, or what you're actually seeing when it comes to fundamentals?
Well, I think you can't ignore either, right? I mean, the only thing we have to go by is history, but and history is very strong. But when you look at fundamentals, that's strong as well. We've seen this is the most expected recession we've ever seen or talked about. And because of that, it just may not be as bad as everyone thinks.
Because why though? Because we're preparing for it?
Because we're so prepared for it. Like when you look at the financial services sector, when you look at banks, they've been preparing for a recession. Think of all the stress tests they've had to endure. Think of what happened in the Great Recession of 2009. So the banks are very much prepared for a recession, and everybody's been talking about this recession that's going to happen. So consumers and businesses, I would say, are somewhat prepared, and they are prepared, and they may be more resilient than you think.
Well, more resilient, but I wonder what that then means for perhaps some of the consumption, some of the spending patterns, not necessarily into 2023, but into 2024, when that's, I feel like, what the markets are now pricing in. It's no longer a this year kind of story.
Well, I think when we talk about what's being priced into the market, I think that's what happened Friday is, the worst case scenario has already been priced in. So if we get any type of good news, like earnings season is taking off Friday with the big banks. If we get any type of good news, the market takes it and runs with it.
Yeah, look at what we saw on Friday. I think that is a perfect way to describe it. With that kind of perfect jobs report that many people saw as being a Goldilocks report, we saw the rally. It's given up a little bit of steam today as the S&P 500 just continues to move lower, down about 0.08%. So, Gina, does that mean that you think markets have bottomed, at least in this cycle?
Well, I think it's really hard to call a bottom. You don't always know where the bottom is until it's over, until it's in hindsight. But I think we have more of an upside than a downside at these levels.
More downside on these levels. It's interesting to me that a lot of people are expecting this turnaround story to happen at the halfway point, the back half of the years when you're going to see a lot more green on the screen. Yep. Gina, why not earlier?
Well, I think we need to get a signal from the Fed, right? The Fed's still very hawkish. And I think that's part of their campaign. It's not what they're doing, it's also what they say. And so, the Fed is on one side, the market's on the other side, and we need to see a little bit of the Fed coming to the middle to meet the market, or acknowledging, because they really haven't yet, they need to acknowledge that inflation is coming down and they're closer to the end of the rate hikes. And
we don't hear a lot of that from Fed speakers, including the...
That's right. And they're all in unison. Yeah. And they're all in unison, and they're all talking the same talk, walking the same walk. And, that's why we think it's going to take longer.
Hey, Gina, just in the last 20 seconds that we have with you, give us a couple areas that you're investing in for 2023. Just got 20 seconds left.
We like financials. We like financials because of, good dividends. And, if there's no recession, they'll do well because of economic activity. If there is a recession, as I mentioned, they're in really good shape. Right. They have valuations, and we like healthcare for dividends, and they have a good demographic tailwind.
All right. Gina Bolvin, president of Bolvin Wealth Management Group, liking for 2023, healthcare and financials. Gina joining us this afternoon from Boston. Follow her on Twitter at Gina Bolvin. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
It is now 3:53 on Wall Street. I'm Doug Krisner, Bloomberg World Headquarters in New York, with a look at some of the company headlines that we are tracking. First, let's begin with this hot headline from the Bloomberg terminal. Apple is aiming to drop chips manufactured by Broadcom by 2025. Apple will instead use semiconductors and computer chips that have been designed in-house. Goldman Sachs is embarking on one of its biggest rounds of job cuts ever. The firm is planning to eliminate about 3,200 positions this week. More than a third of those cuts will likely come from within Goldman's core trading and banking units. We are told the process is expected to begin midweek. Macy's saying earlier today holiday sales were weaker than forecast, and the retailer sees continued pressure on the American consumer in 2023. Disney CEO Bob Iger is asking workers to return to the office 4 days a week, beginning March 1st. Lululemon Athletica lowered guidance for gross margins, and this is stoking fears about profitability for a second straight quarter. You might remember a month ago, Lulu warned that it was going to see lower than expected profitability for the third quarter, and that precipitated a big drop in those shares. We have a rally in shares of Tesla. The company has cut vehicle prices in China, and there are indications that wait times in China are increasing for some Model Y vehicles. And shares in Baxter International down for a second day after the drug and medical device maker said it will spin off its kidney care unit. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec and Kriti Gupta in for Carol Messer this afternoon. Want to get to a Bloomberg exclusive, a scoop from our own Mark Gurman, our colleague out in LA, who was the first to report that Apple plans to replace the Broadcom Wi-Fi Bluetooth chip with a product of its own design by 2025. Kriti, we're certainly seeing shares of Broadcom down now 3.5%.
Yeah, and I'll say Qualcomm not far behind it. QCOM is your ticker, down 1.3% as well. Also coming off headlines that Apple aims to start replacing the Qualcomm modem as soon as 2024. So talking about using their in-house designs.
Yeah, this is quite the scoop. Apple is Broadcom's largest customer and accounted for about 20% of the chipmaker's revenue in the last fiscal year, amounting to almost $7 billion. Qualcomm got 22% of its annual sales from the iPhone maker, representing nearly $10 billion, though that company has warned for years that its Apple reliance will wane. Now we're seeing shares of Broadcom down by 4% after this scoop from Mark Gurman. We're also seeing some other stories that we wanted to get to this afternoon. This one, Kriti, you brought to my attention a little earlier. I know you talked about it with Paul Sweeney in the day. Citadel plotting out an New York City tower in a major build-out after a banner year.
Yeah, it's really interesting because they have this big, fancy tower all planned out. It's expected to be completed in 2032, 10 years down the road. Are people still going to be commuting to work, hanging out in offices? What do you think?
Yeah, I do.
I mean, we'll be here.
Yeah, I don't know where you're going. I mean, I think, I think so. I mean, if you look, if Facebook has its way, if Meta Platforms has its way, we'll be doing this in the metaverse. But I don't know. I do not think that's going to happen. There's still a lot of stuff that you need to do in person. I mean, if you think about healthcare, right? We have the JP Morgan Healthcare Conference kicking off.
Sure.
Healthcare is like all in person. I mean, apart from telehealth, right, which is, certainly a part of it, there's, surgeons can't do their jobs remotely right now.
But for a company like Citadel, for example.
They're not surgeons.
No, but for a company like Citadel, they could do it from home. I mean, at the end of the day, a lot of this kind of infrastructure has been switched during the pandemic. Remember those pictures of traders with 6 screens on their desk at home?
I do.
It could happen.
Yeah, it could. A lot of them are getting back to work, though. Sure. All right, well, don't go anywhere because we're going to be joined by our friends at Bloomberg TV for our Beyond the Bell coverage in just a few minutes. In the meantime, check out the trading day. The S&P now down by 0.3%, down by...
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Scarlet Fu, count you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast, joined right now by Tim Stenovic, Kriti Gupta, in today for Carol Masser. Welcome to our audiences across all of our platforms on Bloomberg, as well as on YouTube. All right, Tim, I'm just looking at it. One stock up right now for basically one stock down. You split the difference. You basically have a market relatively unchanged on the day.
Yeah, it's kind of quite the round trip, right? The S&P 500 up almost 1.5% a little bit earlier in the session, but kind of starting things off where we ended things on Friday. So the question is, what gives?
Well, I think the answer to that is the Federal Reserve, as is the answer to all questions, Scarlett. I think this idea, they're starting to get headlines even coming about midday from Raphael Bostic, really talking about, well, maybe the Fed is willing to overshoot a little bit, spooking a little bit of the risk sentiment, especially in the equity market.
It just goes to show that inflation and the Fed will continue to be drivers for the markets for investors this year, just as they were in 2022. And I know you can't read too much from one day's trading, but it feels like this is the pattern that we're going to see a lot of in 2023.
Yeah, the one-day trading, we should point out, really fits with that pattern, I think, that we've had for really the last few weeks. So it'll be interesting. And speaking of Fed speak, of course, we do get Jay Powell, who's going to be speaking in Stockholm. It'll be overnight U.S. time, so I think something like 4:30 a.m. on New York time.
You think he'll give us a new terminal rate?
I hope not, because I don't think we can take it. But it will be interesting to see just how much he reiterates some of the Fed messaging, whether we get something akin to the Jackson Hole speech or maybe something a little bit softer. Nevertheless, here, the big rally that we had earlier in the day that saw the Dow Jones Industrial Average and the S&P up more than 1% on the day, that is completely flipped. The Dow Jones Industrial Average is going to close today in the red, down roughly 0.3% as we wait for these numbers to settle. The S&P 500 down fractionally on the day, only about 3 points. The numbers still need to be hashed out here, but it looks like it's going to be an unchanged day for the S&P with the red on the screen. The NASDAQ with green on the screen, but only up 0.6% here on the day after a really meaningful rally earlier in the day. And the Russell 2000, which had been posting pretty decent gains earlier today of about 2%, going to finish the day higher by only 0.2%.
You know what they say, when in doubt, zoom out. I'm going to zoom out to the year to date so far. Quarter to date, it's now up 1.4% on the S&P 500. Speaks to the power of what we saw in the wake of last month's jobs report on Friday and the optimism that investors held onto given the wage growth moderation that we saw.
Tim, you're going to zoom out. I'm going to zoom in and take a look at the sector performers when you split up the S&P 500 into 24 industry groups. And what you see is auto and components on the upside, gaining more than 4%. The chip makers and the tech companies have done very well today. It's still holding on to their gains of better than 1%, although hardware has reduced some of its losses. I should say, reduce some of its gains to just 0.5%. On the downside, you've got pharma names, insurance names, and a lot of those consumer staples that had been so resilient in 2022 losing some ground.
Yes, Carla, and I think what's really important to talk about was what's really been leading this rally. One of the big questions when it comes to that sustainable market turnaround story is, can tech actually lead? It's not an issue that every benchmark around the world has, but the S&P 500 certainly does, which brings me to my big three gainers today. The top three index contributors you are looking at on the session: NVIDIA, Tesla, and Microsoft. And this is a really significant deal when you're talking simply about whether or not this is sustainable. At the end of the day, you have to have a broad rally and you have to have tech leading it, because that has kind of been the story of the last 10 years. And how successful can that turnaround be, Tim, when you don't have tech on your side? I think we've seen that pretty clearly last year.
But what about when you don't have interest rates on your side, right? That's kind of the big question.
Yeah, that's fair. But I mean, look, if interest rate expectations stall out, tech is the first sector that really stands to benefit.
Yeah, and before we go on to the decliners here, Tim, I mean, Southwest Airlines, which actually rose today, up about 1.5% here, of course, after having that debacle of a travel season coming out of the holidays, making some interesting promotions in the wake of that here. These are secondary promotions, but basically Adam DeCare now going to become the Vice President of Network Planning and Network Operations Control. There are also some key promotions related to the President of Marketing and Customer Experience, as well as on Culture and Communications. I think the titles, you don't even need to know the names of the people, but I think the titles that they have, I think, gives you a sense here of what Southwest is trying to address.
I mean, Romaine, you and I were covering this that week of disruption. If we recall, you know, the stories of not just customers sitting on the phone for hours to try to reach somebody, but the company saying, if you're not traveling in the next, few hours, try calling us back. Pilots also being required to stay on the phone because they didn't have their assignments either. Hey, Kriti mentioned some of those tech gainers. I want to talk about some of the decliners on the day today, starting with Broadcom. Bloomberg Bloomberg exclusive just moments ago. Shares of Broadcom, ticker AVGO, finished it down by close to 2%. This because of Mark Gurman's story about Apple is pushing to replace the chips inside its devices with homegrown components, and that's going to include dropping a key Broadcom part in 2025. That's according to people familiar with the situation, dealing a blow to one of its biggest supplier. Apple also aims to ready its first cellular modem chip by the end of 2024 or early 25, letting it swap out electronics from Qualcomm, said the people who asked not to be identified because the plans are private. Also, keeping an eye on shares of biotech shares today. The NASDAQ Biotech Index falling 2.3% in its worst day since October. Shares of Regeneron finished it down by 7.7%, the most intraday in more than a year. This after the company reported preliminary EYLEA U.S. net product sales for the fourth quarter of about $1.5 billion. Analysts wanted to see $1.64 billion. That drug used to treat macular degeneration and other ailments. And then Northrop Grumman down 5% on the day today. We saw shares of defense contractors sell off again today. You'll recall, talked about this on Friday, underperformed the broader market amid risks to the U.S. defense budget. Who would have thought at one point we'd be talking about Republican control, meaning that defense contractors would not be getting as much money, Romaine?
Well, yeah, it's an interesting development. I can tell you as somebody who used to cover Congress for a lot of years and just how much certain Congress people like to protect some of those defense industries in their district. I won't hold my breath to see that money actually doesn't get allotted here. We do want to talk about yields real quickly because we talked about that 31 basis point drop that we had on the 10-year yield last week. I think about 17, 18 basis points on the 2-year. That trend continuing here as people do continue to buy here. 4.19, excuse me, on the 2-year right now, 3.5% roughly on the 10-year. Even though at the long end, you're looking at a drop of about 3 basis points in the day. The 30-year, Scarlett, right now at 3.65 and change.
You talk about yields. I think about financials and how they've been traditionally the beneficiaries of higher interest rates. And of course, they're going to be reporting earnings starting on Friday with JP Morgan, Wells Fargo among the big banks starting the earnings parade. And XLF today down about 1/3 of 1%. You really wonder what the message is going to be this time around, because the last 2 quarters it was very much, even though the deal making has been slower, the investment banking fees have been coming in weaker than expected, the consumer was doing very well, and that was the message going forward. And there doesn't seem to be any huge shift to that just yet. It's more about positioning for what could happen in 2023.
What about, though, the other businesses? I mean, the first few banks are going to get, and of course, have big trading and investment banking businesses. And we know, particularly when it comes to investment banking and those deals, it was an awful year, at least towards the latter half of the year.
Yeah, Romaine, I feel like there's a little bit in it for everyone. Tim and I were joking that for some of these bank earnings calls, everyone can kind of pick out what they want to talk about. Tim was very interested in the consumer aspect that Scarlett was just talking about. For me, it's all about the trading revenue, because to me, that speaks a little bit more about where they're forecasting volatility to be in the next couple of quarters. What do you think, Tim?
Well, it goes back to the conversation that we had just moments ago with Gina Bolvin over at Bolvin Wealth Management. She joined us from Boston this afternoon, and she said, Scarlett, that this is the most talked about and anticipated recession that she's ever seen in her career. And what she meant by that is that consumers, she thinks, will be prepared for a recession. Companies will be prepared for a recession if we hit them. And that makes sense that it would be less mild in that sense because it wouldn't hit us by surprise.
Yeah, companies will be prepared, and you wonder how they're going to prepare this time around. And in the past, we know that cutting costs through job cuts was a favored way of reducing that overhead. But given how difficult it's been to hire people, a lot of companies are going to be reluctant to fire people because it'll be so difficult to ramp back up. Exactly.
All right. Well, we got a lot of catalysts for the markets this week. I think we already mentioned Jay Powell going to be speaking overnight. We're going to get some optimism, small business optimism data. You talk about also the idea of that JP Morgan Healthcare Conference and all the things coming out of that, and then a CPI report. I don't know if you remember this, Tim, but the last CPI report, there was the 60 seconds of trading here that Bloomberg Economics did a great study that showed that Scarlett Fu was trying to front run that report. I don't know if
what do we do this time, Scarlett? What should we do?
Yeah.
That's the question.
You know, don't look for me at around 8 a.m.
Yeah, don't look for it. Yeah, in all seriousness, she would never do that. But we do joke a lot about that and the idea that the markets really are hinging on every single economic data point, because it really is about the aggregation of it all. If you look at the jobs report from last week, you would say, okay, great, maybe there is moderation. Is that what we're going to see on Thursday?
Well, then you also have, don't forget, the ISM services report, which if you actually look at the kind of crux of the market reaction, Tim, a lot of it was jobs, but a good chunk of it was that services data as well. So it looks like investors taking literally everything into account.
Just wait till Fed Chair Jay Powell takes away the football again tomorrow. It's like Charlie Brown. That's what it feels like, certainly. All right, guys, that is going to do it. We are going to bring you live coverage, though, of all of those events that Romaine just went through for the remainder of the week. That is going to do it for our Beyond the Bell, our cross-platform coverage of the market close on Bloomberg TV, radio, and on Quick Take. Meantime, catch us and our TV colleagues tomorrow, same time, same place for Beyond the Bell. We talk markets, but what about private markets? We do spend a good time talking about them, but we really want to get into it with Scott Sperling, the co-CEO at Thomas H. Lee Partners. He's a great voice when it comes to everything that's happening when it comes to privates, alternatives. He's been a decade with the Harvard Management Company, overseeing alternative assets for Harvard's endowment. He's joining us now with an outlook on private equity. It's good to have you with us, Scott. How are you?
Thank you. Good. But beautiful day in Boston. What more can we ask for?
I mean, I guess what more we could ask for is, I don't know, a decade of near zero rates, but that's neither here nor there.
I think that prayer was already answered.
Okay,
now what?
We got that. The question is now what? So now what in 2023 and beyond as the Fed looks at or I guess traders look at a terminal rate of 5%?
Which, when you look historically, is not all that high.
That's what everybody keeps saying, Scott. It is if you're under 40. That's the truth. And I don't mean that in a funny way. I truly mean that. Look at the percentage of people you have on Wall Street now who've never lived in an interest rate environment, that we saw in like the 70s, 80s, or 90s.
An amazing percentage actually didn't live through the great financial recession in 2008.
No, you gotta live through that.
Now, fortunately or unfortunately, I still remember the first mortgage that my wife and I got back in 1981.
Can I guess?
Was 17.5%.
Yeah, I was going to say 15. I mean, that's the thing. So, okay, so does that mean we have a repeat of the 1980s?
Yeah, so I don't think so. I think that the world has evolved. The nature of the business models that are prevalent in the preponderance of the value in the public markets and also in the private markets is much better than the nature of the business models that existed back in the 80s. I think the ability to better control inflation does exist relative to where we were in the late 70s and early 80s, given the enormity of the pop in energy prices. But what we are losing is the benefit of 20 to 30 years of strong anti-inflationary forces, such as technologies that allowed us to produce much more energy at much lower pricing, technologies and the ability to move manufacturing globally to places that could do it much less expensively. And we are in a period where the cost of regulation is going up. Those three very anti-inflationary forces that predominated for most of the last 2 to 3 decades allowed the Fed and then more recently fiscal authorities to pump enormous amounts of liquidity into the system without causing inflation. And that resulted in that zero interest rate environment that we referred to that we've already had the benefit of. As we look forward, because those anti-inflationary forces have been reversed or at least have run out of steam, and we are looking at a series of things that will be a challenge from an inflationary perspective in terms of putting it back in the tube. Most forcefully, let's look at wage price inflation and the need for people to get ever higher wages to deal with the ever higher cost of living. The Fed is going to be very focused on trying to do whatever it takes to not put us back into a situation that we experienced in the 80s. And I think there's a high probability they will succeed. The bigger question is, what's the new normal when we get there? Is it 4 or 5% interest rates or 3.5% interest rates? can they get to 2% inflation, or will we be back in a world of about 3 to 4% inflation that would have been nirvana as we thought about it for most of the 1970s, 80s, and even into the 90s, but seems very high today. And the implication for that is what you've been talking about, which is it has a very significant impact on the way that we price the value of companies in the public markets and also in the private markets for those of us in private equity.
Well, Scott, let's bring it back to your point, the private markets. I'm curious what the bull case is for private markets at a time when I think it's widely understood that private lags the public markets. And if there's still a lot of pain in store for the public markets, then by definition, does that mean there's still going to be a lot of pain in the private market? So what is the incentive to pursue that?
Well, I think that there are two sets of opportunities. And, you know, interestingly, if you look at the data over the course of the last 30 years, it has been periods of economic turmoil where you have the most attractive investing opportunities for private equity because of the nature of the patience that we can have as an investor, and because of the ability, at least for firms like ours, who can help companies better navigate difficult financial situations. When we see this kind of disruption in valuation, that tends to be an attractive time to invest. You're exactly correct, though, about the lag time. So the public markets have corrected. Maybe a lot of things aren't cheap, but they're certainly a lot lower priced than they were 6, 12, 18 months ago. And there are a lot of companies that, again, have very good business models. Think about some of the technology companies, particularly things that have high recurring revenues. Those are good business models to invest in.
Well, let's talk about
what's the right multiple level.
Well, let's talk about some of these companies. Definitely interested in hearing about your thoughts about some of your portfolio companies. Let's just go with auction.com, for example. The company sells foreclosed homes. Would love to hear what you're seeing when it comes to the pipeline for foreclosures and bids for these properties, because it can kind of tell us about the broader economy.
Sure. So to be clear, auction.com itself is not involved in the foreclosure process or chain of ownership of foreclosed properties. So it's a technology platform that is a automated marketplace that allows the folks who own that mortgage paper or the actual foreclosed property to much more efficiently and hopefully with many fewer errors go through the process, if necessary, of foreclosure, and then be able to put that property back into the market at the lowest possible cost, most efficiently. So auction.com is a technology company that serves the folks who are involved in the mortgage market more broadly, but specifically to help ensure that the foreclosure process is as accurate as possible, and that the folks like Fannie and Freddie, who often own that paper and take those properties, can then put that property back into the market as efficiently.
So what are you guys seeing in that business right now?
Possible. You know, I would say that there's certainly a turn up in the number of foreclosures, but you know, we're nowhere near what happened during the Great Financial Recession. Obviously, as we anticipate a more difficult macroeconomic environment, that may change a bit. And
right.
The higher volume of foreclosures.
Hey, Scott, we got to run 30 seconds left. Just a comment on Hightower Advisors, wealth management, given the 2022 market plunge. How's that line of business? 30 seconds.
These RIA advisory businesses are good, strong businesses. We've seen continued significant growth, very strong secular forces driving towards the RIA from the wirehouse. What we've tried to do is build the industry-leading platform, again, using technology and the ability to scale services to the individual advisors.
Scott Sperling, we love talking to you. You got to come back and join us again soon. He's CEO of Thomas H. Lee Partners. He spent years at Harvard Management overseeing privates for Harvard's endowment, private equity. Really good to have you with us, Scott Sperling. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
Through most of the day, markets expressed a little bit of confidence here in the Fed being able to slow the pace of rate hikes. You remember what we learned at the end of last week? U.S. wage growth cooled. The services economy is now in contraction, and manufacturing activity, if you look at the factory orders data, down more than forecast. So then the debate really was, hey, is the Fed in a position to cut rates by the end of the year? Through much of the day, that kind of supplied the oomph. We had a rally in the equity market. Yields were down across the curve and some dollar weakness. That's not really what the Fed would prefer to see. Enter the head of the Atlanta Fed, Raphael Bostic. He weighed in and said the Fed should hike rates above 5% by early in the second quarter and then go on hold for a long time. That helped to take the steam out of the equity market. We finished mixed with the Dow down today 0.3%, the S&P weaker by 0.1%, the NASDAQ composite rising about 0.6%. A key driver going forward is going to be the quality of earnings. Morgan Stanley's Mike Wilson was saying today, corporate profit estimates are still too high. Now, the big banks will kick off earnings season on Friday. That's when we'll hear from J.P. Morgan. Today, Goldman Sachs embarked on one of its biggest rounds of job cuts ever. We are told the firm is planning to eliminate 3,200 positions beginning this week. Look at Goldman shares, up 1.4% today. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Really appreciate it. Bloomberg Business Week is brought to you by Innovation Refunds. Small businesses impacted by the COVID-19 pandemic may qualify for the Employee Retention Credit. Let Innovation Refunds do the work to find out now if your organization qualifies for ERC assistance. They've already helped businesses claim over $2 billion in payroll tax refunds. Learn more at getrefunds.com. Well, J.P. Morgan Chase's healthcare conference in San Francisco kicks off today. It is the biggest in-person gathering of the industry in 3 years. Remember, last year's in-person event was canceled due to COVID. We're talking 8,000 people in person, but 40,000 others, like bankers, lawyers, executives, and investors, all in San Francisco for the event. One of the executives who's there right now is Dr. John Scarlett, CEO at Geron Corporation. It's a clinical stage biopharma company with a market cap of about $1.2 billion. You might have seen the headlines last week. The shares spiked the most in 20 years after positive phase 3 results in blood cancer treatments. Shares did finish the week up only 3%. They fell after the company announced an offering of $175 million in shares. A very pleased to have with us this afternoon Dr. John Scarlett, CEO at Geron Corporation. How are you, Dr. Scarlett?
Hey, I'm great today. Thanks for having me on the show.
Hey, well, I want to get to last week's news in just a minute, but first give us an update from San Francisco and what it's like to be back at the J.P. Morgan Healthcare Conference for the first time in 3 years.
Well, it's hard to believe it's been 3 years in one way. It feels like many of us have been doing this most of our professional lives. On the other hand, it's great to see people in 3D here for a change, so it's great.
It's kind of wild to think that, I mean, it's kind of a little meta to be thinking about this, right? The fact that people are able to meet in person now has a lot to do with the innovation that we've seen in biopharma over the last few years. I mean, the millions of lives that have been saved as a result of vaccines that were developed as a result of Operation Warp Speed and through the private sector, the public sector as well. Just take a moment to give us an idea of what that means for you, because this conference is happening essentially like everything else because of that.
You know, you couldn't have said it better, to be honest with you. The people in my industry, the biotech world, took huge pride in the rapidity with which barriers could be broken down, new vaccines be developed. I think it's a sign of tremendous health in the sector. And I, for one, was really proud to be associated with this group of people who responded so magnificently. And you're right, we're all here. Most of us are able to partake of this essential human interaction in a way that we haven't been able to do in the past. So I'm very thankful and very grateful.
Well, let's now talk about the big news from last week that we saw shares spike the most in 20 years after the positive phase 3 results in blood cancer treatments. Talk about those results and the takeaways that you had from that announcement.
Well, you know, we were so happy to be able to report that we had positive top-line results from a large phase 3 study that had been going on for 3 years. This is in a disease called lower-risk myelodysplastic syndrome, or MDS. It's a form of blood cancer. It was a great day for patients with low-risk MDS that really delivered on the promise of a scientific story that had been in the making for 20-plus years, had Nobel Prize-winning science behind it. But, you know, as people are often want to say in my business, it's a long, hard path to really getting to this stage of positive phase 3 results. So for us, we are exhilarated by the fact that it looks like we can help a broad set of patients stay off of blood transfusions for an extended period of time. And it was that decades-long commitment for us. And, of course, for our shareholders, we expect these data to translate to a very meaningful potential commercial opportunity in lower-risk MDS. So overall, a great day.
So why do you anticipate patients with this particular blood cancer would benefit from new medicine if there's therapies that are already out there?
Right. Well, one of the things that's very exciting about imetelstat, which is the name of the drug that we've been developing for some time, is that it has the potential for modifying the underlying disease that's responsible for these patients' illness. And in doing so, that gives us the potential to see the clinical outcomes that we were able to report last week. Specifically, we had very compelling durability of transfusion independence. That means patients were able to get off of blood transfusions for, in many cases, approaching 24 to 48 weeks, close to a year. And we also were able to treat a very broad group of patients with this disorder, with being agnostic to some of their underlying presenting signs and symptoms. So overall, what we were able to show was an ability, as I said, to have a durability of effect that we haven't seen before. And let me say very quickly, I think people kind of think, oh, blood transfusions, that's what you get if you're in an automobile accident, you've lost a lot of blood. But these are patients whose bone marrows aren't really producing adequate amount of blood cells. And so they have to take upwards of 6 or even more units of packed red cells over 8 weeks. That means they're in an infusion chair and their doctors are in their hematologist's office for many hours getting that. And blood transfusions bring with them a lot of challenges, including getting an iron overload situation with your internal organs. So getting people off of blood transfusions both is good for them from a social perspective and for their own lives and their sense of well-being, but it's also good for their medical conditions. So that's what we're really celebrating today.
John, you mentioned that this is a long road when it comes to drug development. So we had the phase 3 results that were released last week. What comes next? And what's the timeline when this hits the market?
Great. Yeah, great question. So, of course, what you usually do in this business is you show at some point, just looking back for just a second, you sort of show the promise of the drug, and then you've got to take it through dose finding and then eventually get to an end of a phase 3 result. For us with this disease and this drug, that was many, many years. But now that we've got the phase 3 results, I hope it accelerates quite a bit. We expect to file a new drug application, which is, asking the government for the approval to sell this drug, file that application in mid-2023, so sort of relatively speaking around the corner. The same in the European Union by the end of the year. And then, depending on a couple of different variables, if approved, hopefully beginning the commercialization of the product as early as 2024 here in the United States. So it does all of a sudden accelerate when you get really good data, which is what we have.
Well, let's zoom out here and talk a little bit about your company specifically. Last week, you announced a capital raise of about $198 million. What is that capital going to be used for over at Geron?
Yeah, so first of all, that will take us, we expect now, that will take us care of our cash needs through the end of 2025. That period of time should cover all of those applications to regulatory agencies, should cover hopefully getting approvals in these various geographies, and then actually launching the product and getting into the first or second year of launch. So that's a lot of capital, but it's really important to have it so that you can have a really good profile as a new drug on the market.
Was the timing of this, just in the last 30 seconds we have, was the timing of this, on purpose? The results come out and then you announce this?
Yes, absolutely. It's no time to make hay like when the sun is shining. And also on top of that, we wanted to get that in before the JP Morgan conference where everybody's running around and not paying attention to potential offerings. So it worked out great for us, and we're really grateful and thankful for that.
Well, we're certainly grateful for you taking the time. I know you're really busy at the JP Morgan Healthcare Conference in San Francisco this week. That's Dr. John Scarlett, CEO of Geron Corporation, the biopharmaceutical company. Really appreciate you taking the time joining us from San Francisco this afternoon. Once again, Dr. John Scarlett, CEO of Geron Corporation. Well, taking a look at how equities ended the day today, we saw kind of a round trip when it comes to the S&P 500. It was as much as up as more than 1% today, but ended up finishing the day down by about 0.08%, just down 3 points. The Dow finished the day down by 0.3%. The Nasdaq holding on to those gains, though, up 0.6%. Let's get an update on world and national news. Nancy Lyons is in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. A new rules package will be voted on by the U.S. House tonight. The chamber will vote on concessions that House Speaker Kevin McCarthy made to conservative lawmakers who were staunchly opposed to his candidacy. Well, House Republicans have also agreed to restart the House Select Subcommittee on the coronavirus pandemic. We get details on that from Bloomberg's Amy Morris.
Under Democrats, the panel spent most of its time looking into the Trump administration's response to the coronavirus pandemic. Under new GOP leadership, it will broaden its focus, looking into the origins of the pandemic and the impact of vaccine mandates. They'll also look at the federal government's funding of, quote, gain-of-function research and the role of Dr. Anthony Fauci, who was the White House chief medical advisor and whom Republicans say they'll call to Capitol Hill for questioning. In Washington, I'm Amy Morris, Bloomberg Radio.
Brazil's capital is picking up the pieces, and President Lula da Silva is promising more arrests after supporters of ex-president Jair Bolsonaro stormed government buildings in Brasilia yesterday. Bloomberg's Julia Leite is in Brazil with the latest on the situation.
It's a swath of evidence that police and the ministries now have to go through. Lula, meanwhile, is reasserting his power. He met with the chiefs of Congress, the chiefs of the Supreme Court today, really putting up a united front against these protests and looters, really.
Bloomberg's Julia Leite reporting from Brazil. Buffalo Bills safety Damar Hamlin is back in Buffalo after being released from a Cincinnati hospital where he's been recovering from experiencing cardiac arrest on the field a week ago. Dr. William Knight says he'll now be treated at a Buffalo hospital.
He is doing well, and this is the beginning of the next stage of his recovery.
Dr. Knight says it's too soon to say if Hamlin will again play football. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
The equity market was mixed today. We'll unpack that momentarily. It was kind of interesting because right before the closing bell, we learned that Apple is pushing to replace the chips inside its devices with components designed in-house. Now, the change will include dropping a key part from the chipmaker Broadcom sometime in 2025. Today, Broadcom shares were down 2% on this news. You know, through much of the regular session, markets had been betting on the Fed slowing down the pace of rate hikes. If you'll remember what we learned last Friday, U.S. wage growth cooled, the services economy now is in contraction, and factory orders down more than forecast. So the debate really centered on whether or not the Fed would perhaps be in a position to cut interest rates before the end of the year. Today, we had another rally in the stock market, similar to the case on Friday. Yields were down, and the dollar was weak as well. That is not exactly what the Fed would prefer to see when you talk about tightening financial conditions. Well, then we heard from Atlanta Fed Bank President Raphael Bostic. He weighed in and said the Fed should hike its key rate above 5% by early in the second quarter and then go on hold for a long time. And that promptly helped to alleviate some of the enthusiasm. The equity market finished mixed and well off the best level of the day. If you look at the Dow, we were actually down 0.3%. The S&P off about 0.1%. NASDAQ comp finishes higher by 0.6%. Macy's holiday sales weaker than forecast. Those shares were hard hit today. And Lululemon warning of lower guidance on gross margin. Lulu shares today down more than 9%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Hey, Doug, thanks so much for that update. Really appreciate it. I don't know about you, Creedy, but when I get on an airplane, I always look to the left, and I like to see a couple of pilots in the cockpit getting ready to fly that plane to wherever I'm going. Here's the thing. Those days might be coming to an end, where we have actual human pilots in the plane with us. Is it going to happen during our lifetimes? Merlin Labs is an aviation technology company that's working on AI technology to allow planes to fly fully autonomously. They've got the tech already. They use them in King Airs right now. The company over the summer raised more than $100 million to bring their total funding to about $130 million. Matt George joins us now. He's the CEO of Merlin Labs. He joins us via Zoom from Alaska. So if you're watching us on YouTube or Bloomberg Quick Take, you can see him right there. Matt, good to have you with us. How are you?
Hey, great to be here. Thanks so much for having me.
Yeah, thanks for joining us. Everyone knows I love talking planes, so this one I've been pretty excited about. So are we going to be taking passenger flights without human pilots in the plane with us anytime soon?
Yeah, I want to pour some cold water on that.
Okay.
The pathway for autonomy is really adjunctive to pilots. So a lot of the stuff that we're working on at Merlin is truly how to be able to go create an AI pilot. But unlike some others in the space, we fundamentally don't believe that you can put that pilot alone in the cockpit, at least at first.
Alone in the cockpit, meaning
Correct.
the co-pilot will still need to be there? Or
Yeah.
meaning that you could fly with just one pilot?
Yeah, so we are working a lot with our operators. We made a big announcement in the United States Air Force about being able to go pair the Merlin pilot, which is what we're developing, with a human pilot to enable safe aircraft operation. So just like any student pilot, there's a really long period where that pilot has to be supervised and trained by a human. And it's the same with any AI system. And once again, we're starting out first with some of our partners in the Defense Department, specifically working on some cargo and mobility applications, and then also working in the civilian realm on cargo. So the end state of Merlin is being an adjunctive pilot on large passenger aircraft. But then also what that enables is that Jetsons future, in a far distant future where aircraft are flown completely without human aircrew aboard. But baby steps to be able to go get there.
Far distant, how many years is that?
Oh, if I had a crystal ball, I would be in a very different business. But we will be performing our first commercial flights, certified commercial flights, in the next about 2 years, with the Merlin pilot in charge, but still with a human crew member sitting next to the Merlin pilot.
Well, as incredible as that all sounds, it also sounds a little terrifying. I'm not going to lie. Talk to us a little bit about the pushback that you're getting here.
Yeah. So anything in aviation has to be done super safely, right? Like there's a reason that flying is actually one of the safest activities you can do, much more so than driving. And that reaction is like really real. So that's why we believe that the autonomous system has to be paired with a human pilot, and not just sort of putting anybody alone, sort of in an aircraft that's totally uncrewed. But once again, right, elevators without human operators were really scary at one point, and then the technology matured to the point where we were able to go deliver that safely. Trains without human operators were really, really scary, and then the technology got to the point that we were able to go do it. So we believe in Merlin and the crawl, walk, fly approach to be able to go get there, to be able to go do it safely, and to build that public regulatory and operator trust in the system. But once again, it's not going to be overnight where the aircraft are flying without anybody aboard. There's a long period where computer and trained human pilot are teaming up together to provide a really safe experience, first for boxes and cargo, and then eventually for people.
So we've been covering this for a couple of years, but the pilot shortage that's played out here in the U.S. Since COVID is really creating some difficult situations for many operators. What are you hearing from commercial aviation firms, airlines, about their desire for this type of technology? Because not only would it save them a ton of money, but it would alleviate a lot of headaches too.
Yeah, so the internet provides ubiquitous digital connectivity for the world, and then the air network provides ubiquitous physical connectivity. So as people buy more and more things online, I don't think there's anybody who realistically believes in a world where folks are going to start buying stuff less online. So as people buy stuff more online, the demand on the air cargo network is shot through the roof. So for our operators, being able to go introduce an AI pilot to be able to go augment human crews is just like really fundamental to them being able to go keep up with the demand for the air network. So it's been really exciting. It's the inevitable future of aviation, and we're delivering on that inevitable future of aviation in a really pragmatic crawl, walk, fly approach.
Well, talk to us a little bit about the business itself, because I'm reading a little bit about your company here. Founded in 2018, you're headquartered in Boston. You've got offices around the country. You also have offices in New Zealand. Why New Zealand?
We have an incredible team in New Zealand. We partnered with the government of New Zealand to be able to go certify the first version of the Merlin pilot, and that's a joint certification program between the New Zealand Civil Aviation Authority and the U.S. Federal Aviation Administration. New Zealand has built an incredible reputation as being a nimble, agile regulator that's able to go try new things and do that in a really safe and reliable way. So we are standing up the world's first fully autonomous, still with a safety pilot, but fully autonomous takeoff to touchdown air cargo network on the North Island of New Zealand, based in Kerikeri in the Bay of Islands in New Zealand. And New Zealand really is, going to be one of the first places in the world where a lot of the autonomy takes place first, gets tested, and then exported into the rest of the world. We're super proud of our partnership between the U.S. and New Zealand, and being really critical link between those two countries.
Yeah, it looks like even in New Zealand right now, just to speak to that reputation that it's built, you can get drone delivery of certain products through Wing, food, coffee, hardware, pet supplies, and more. So not surprised to see that you have a presence in an environment that has a regulatory environment such as that. So Matt, before we let you go, talk to us a little bit about this partnership that you have with the U.S. Air Force, the Super Hercules transport aircraft. So what can you do, and the U.S. Air Force do now, to the Super Hercules that you weren't able to do a couple of years ago?
Yeah, we're really excited about our partnership with the United States Air Force, who clearly has been trying to bring autonomy out into operational service for a really long time. And the challenge always is the problem and the question that you alluded to at sort of the start of our chat. How do you get from where we are today to fully uncrewed operations? Yeah. The Air Force has partnered with us to be able to go do sort of that two-crew, an augmented service. So we're working with them to be able to go integrate the Merlin pilot onto the C-130J, where the Merlin pilot will partner with a human, pilot in the cockpit. Right. And that will enable the Air Force to be able to go move stuff around with, fewer human air crew, and enabling those air crew to go focus on higher cognition missions, and ultimately ensuring that those air crew are utilized in the best possible way and the safest possible way.
Matt George, CEO of Merlin Labs, the company that's developing autonomous flight technology for fixed-wing aircraft. Really appreciate you taking the time and joining us this afternoon. This is Bloomberg.
It is now 4:53 on Wall Street. I'm Doug Prisner at Bloomberg World Headquarters in New York as we check some of today's company headlines. We begin with Apple. The company is pushing to replace the chips inside its devices with components designed in-house. Now, this change will include dropping a key part from the chipmaker Broadcom by 2025. Apple, by the way, is Broadcom's largest customer, accounting for nearly $7 billion in revenue. Apple is also aiming to use its own cellular modem chip by the end of 2024 or early 2025 as it swaps out electronics manufactured by Qualcomm. Apple had previously expected to replace the Qualcomm component as soon as this year, but the development snags that we have seen help to push that timeline back just a bit. Goldman Sachs is embarking on one of its biggest rounds of job cuts ever. The firm is planning to eliminate about 3,200 positions. It may happen as soon as midweek, with more than a third of those cuts likely coming from within Goldman's core trading and banking units. Macy's saying today holiday sales were weaker than forecast, and Macy's sees continued pressure from the American consumer in 2023. Disney CEO Bob Iger asking workers to return to the office 4 days a week beginning March 1st. And Lululemon Athletica lowered guidance for gross margin, and this seems to be stoking a bit of fear about profitability for a second straight quarter. A month ago, the company shares tumbled when Lulu reported lower than expected profitability. Those are some of today's company headlines. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec and Kriti Gupta in for Carol Masser this afternoon. Let's get a check on the latest world and national news. For that, we turn to Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden is in Mexico for the North American Leaders Summit. It is his first time there since taking office. He's set to discuss migration issues with the country's president and Canadian Prime Minister Justin Trudeau. Other topics on the agenda include fentanyl trafficking, trade, and economic development. Well, President Biden spoke today with Brazil's president following major unrest and looting in the Brazilian capital. And national security officials say the Biden administration will seriously consider an extradition request from Brazil for former Brazilian President Jair Bolsonaro, who is reportedly in Florida. But we're told there has been no official request for that. State Department spokesman Ned Price says the U.S. stands with Brazil as it safeguards its democratic institutions.
We've seen remarkable resilience from Brazil's democracy over the past 24 hours. The violence was quelled within hours. The institutions were cleared of violent protesters within hours.
Again, the State Department's Ned Price. The UN is touting some positive environmental news, as we hear from Bloomberg's Nathan Hager.
A panel of UN scientists says the ozone layer is on course to recover within 4 decades. The group says it's a credit to the 1987 Montreal Protocol, the global agreement to phase out harmful chemicals that deplete the Earth's protective shield against ultraviolet radiation. Under current policies, the ozone layer is expected to return to 1980 levels by 2066 over the Antarctic, by 2045 over the Arctic, and by 2040 in the rest of the world. In Washington, I'm Nathan Hager, Bloomberg Radio.
Tonight, Georgia will look to become the first back-to-back champion in the college football playoff era. The top-ranked Bulldogs will take on third-ranked TCU at SoFi Stadium in Inglewood, California. Kickoff set for 7:30 p.m. Eastern Time. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Kriti and Tim.
Thank you so much, Nancy Lyons. Really appreciate it. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to apply for a payroll tax refund if your small or medium-sized business was impacted by COVID-19. Innovation Refunds clients already claimed over $2 billion in payroll tax refunds. Get started at getrefunds.com. Well, President Biden is attending the North American Leaders Summit in Mexico City to mark his first foreign trip of the year. We've got Joe Matthew right now from our 99.1 studio in Washington, D.C. Joe, what's top of mind? Of course, we saw the president yesterday with Governor Greg Abbott of Texas, who delivered him a sternly worded letter about what he wants to see at the border.
Well, I think you just answered your own question. That is what's top of mind, right? It's that very letter. And exactly just the scathing criticism that came from an outraged governor to set him up for this trip when they're not going to solve the immigration crisis, but they are making some progress on some interesting things here. That trip to the border, though, my goodness, it's something that's going to resonate for a while. It was, by critics' view, a photo op, but there was probably more involved in that in terms of getting the conversation started.
So, Joe, you also have today a Speaker of the House.
Yeah, can you believe this?
I can't believe it. I didn't think it would happen. But
it actually almost came to blows, as you might have seen. Early Saturday morning, they were ready to start throwing punches on the House floor. Remarkable. But tonight is the real test now of this whole architecture that he kind of set up for himself with a lot of deal making. This rules package that basically did all the arm twisting is up for a vote tonight. They're going to gavel in just about 1 minute from now. And we'll have a lot more for you next hour.
All right, we're looking forward to that update with Joe Matthew. Sound On starts in just a couple of minutes right here on Bloomberg Business Week. Joe, not just talking about the new Speaker of the House, Kevin McCarthy, but also, of course, about the president's trip to the border and to Mexico City. For the day that ended today, the Dow down 0.3%. The S&P 500 finished the day down just fractionally, close to 0.1%. The NASDAQ finished in the green higher by 0.6%. Big thank you to Kriti Gupta for filling in for Carol Massar this afternoon. I'm Tim Stenevec. Sound On with Joe Matthew starts now.
Bloomberg's world headquarters in New York.
And I'm Ed Ludlow, also in New York City. This is Bloomberg Technology.
Special day coming up. Apple racing to ready in-house chips by 2025. And it has big implications for its suppliers. Shares of Broadcom dropped on the Bloomberg scoop. We'll discuss in a moment.
And a big tech rally loses steam as Fed officials signal interest rates going beyond 5% and earnings come into focus, as well as CPI just around the corner this Thursday. Semiconductors outperform.
And Chinese stocks roar back after signs the government is winding down its tech crackdown on data protection, on online gaming, and investments in foreign entities. So much to get through. The market moves, we kick them off with, of course, the move that was a torrid day, volatility front and center, and that's probably likelihood for most of 2023. S&P 500 actually falls on the day, having been up more than a percentage point. All trading at the start was about hopes of a reopening in China, optimism of their economy recovering, and therefore the moon music for risk assets plows in. Also, the hope that inflation might